Ever felt completely lost when watching the stock market news? What on earth does a dead cat bounce have to do with your money? Why are stocks suddenly bearish or bullish? Are we at a zoo? Imagine understanding every strange phrase the moment you hear it. Today, you'll learn the secrets behind every stock market term in clear, simple language. The stock market isn't just numbers. It's a secret language built over centuries. Traders shouting orders, screens flashing bright colors, fortunes rising and falling instantly. Behind this chaos are hidden codes like IPOs, dividends, short squeezes, and ETFs. Each word tells a story of success, failure, greed, or wisdom. Understanding this language can drastically change your investing game. Consider the infamous Wall Street crash of 1929. Panic selling birthed terms we use today, such as crashes and corrections. Fast forward to the dot-com bubble in the late 90s. Investors learned painful lessons from phrases like burst bubbles and irrational exuberance. These events transformed how we speak about money today. Familiar names like Warren Buffett and Peter Lynch also shaped our market vocabulary. Buffett famously popularized value investing. Lynch taught everyday investors to find 10-bagger stocks. Every market term has a fascinating history hidden beneath it. Let's explore these terms and stories step by step. Ready to decode these mysterious terms and take control of your investing future. Before we dive in, let's build suspense around how crucial understanding these terms is. Consider the story of GameStop's meteoric rise in 2021. This event introduced millions to the term short squeeze. Or when Facebook went public in 2012, everyone suddenly talked about IPOs. Imagine missing out because these terms felt intimidating or unclear. Each term directly influences real-life investing choices. Imagine buying at the peak because you misunderstood a dead cat bounce, or panicking during a healthy correction, losing thousands unnecessarily. Investors who master the terminology see clearly in times of chaos. They seize opportunities others miss. They also avoid painful and expensive mistakes. Each word carries the weight of history and countless investors' experiences. Understanding them empowers your financial journey. Now, let's dive deep into these fascinating terms one by one. First, let's decode the most iconic market terms, bulls and bears. A bull market means prices going up, optimism everywhere. Visualize a bull thrusting upwards, symbolizing profits rising. A bear market means prices falling, fear rules. Think of a bear swiping downward, symbolizing losses. Historically, bull markets last longer, but bear markets hit harder and faster. The dot-com bubble was a classic bull market turning bearish overnight. Learning to spot these shifts is crucial for successful investing. Understanding these terms can literally save your portfolio. Next, let's tackle IPOs, the glamorous gateway to Wall Street. IPOs mark a company's debut to the public markets. Imagine a grand party. Only everyone is invited to buy shares. Famous IPOs include Facebook, Tesla, and Alibaba. IPOs can create overnight millionaires, but also huge risks. Remember, Facebook lost nearly 50% of its value initially after going public. Investors learned IPOs aren't guaranteed wins. Knowing IPO dynamics can prevent painful beginner mistakes. IPO investing requires caution. Don't get carried away by the hype. So should beginners ever buy IPOs? More on this later. Dividends are steady cash payments. Stocks give you regularly. Imagine your stocks sending you a paycheck consistently. Blue chip stocks, Apple, Coca-Cola, Microsoft, are famous dividend payers. Investing in dividends provides income even during market dips. These stocks are like anchors in stormy markets. But can dividends alone make you wealthy? Dividend strategies work best with patience and consistency. Stability in volatile markets is the power of dividend investing. But what if you want broader market exposure? Enter ETFs and mutual funds. ETFs are baskets of stocks you buy easily, like individual shares. Mutual funds also pool investor money, but trade less flexibly. ETFs have exploded in popularity due to lower costs and ease of use. Mutual funds offer professional management, but often come with higher fees. Which one is better depends on your investing goals. ETFs for simplicity and speed, mutual funds for active management. Knowing this difference saves money and frustration. Choose wisely based on your investment style. What about short selling? How did this cause chaos in GameStop? Short selling means betting against a stock, profiting if prices fall. Imagine borrowing a book, selling it now, hoping the price drops later. GameStop became famous due to a massive short squeeze. Investors banded together, buying heavily, causing prices to skyrocket. Hedge funds lost billions overnight. Short squeezes are risky but powerful if understood clearly. They highlight how quickly markets can shift when sentiment changes. This term teaches the importance of market psychology. Next, why should investors beware of the infamous dead cat bounce? A dead cat bounce describes a temporary rise after a significant stock decline. Imagine dropping a ball from a height. It'll bounce briefly, but won't regain its original height. Investors often mistake this temporary recovery for a real comeback. Understanding this helps you avoid buying stocks that haven't truly recovered yet. Let's clarify another vital term: market corrections. Corrections occur when markets fall around 10% from recent highs. Think of corrections as markets taking a much-needed breather. Corrections often provide excellent buying opportunities for patient investors. So, what makes a correction different from a market crash? A crash is much more severe, typically a drop of 20% or more within a short period. The 2008 financial crisis was a classic example of a devastating market crash. Knowing this distinction helps manage emotions during volatile markets. Next is dollar cost averaging, an essential investing strategy. Dollar cost averaging means investing the same amount regularly, regardless of market fluctuations. Imagine consistently planting seeds. Eventually, you'll harvest regardless of the weather. This method reduces emotional investing and provides steady returns over time. Another crucial term is liquidity. Liquidity refers to how quickly an investment can be converted into cash without losing its value. Cash in popular stocks like Apple have high liquidity, while real estate has lower liquidity. Understanding liquidity helps you choose suitable investments for your financial goals. Market cap, short for market capitalization, is another important concept. Market cap measures the total value of a company, calculated as stock price multiplied by outstanding shares. Companies like Amazon have huge market caps, signaling market strength and dominance. Investors use market cap to identify growth potential and risk. Let's tackle PE ratios next, a key metric investors rely on heavily. The price-to-earnings ratio indicates if a stock is undervalued or overvalued compared to its earnings. A low PE suggests undervaluation, while a high PE may suggest overvaluation or strong future growth. Understanding PE ratios helps you identify smart investments. What about volatility? Volatility measures how drastically a stock's price moves up or down. Imagine a roller coaster. Volatile stocks experience rapid ups and downs. Volatility can lead to greater profits, but also greater risks. Next up, bear traps. A bear trap happens when investors mistakenly believe prices are heading down, but they suddenly surge. Investors who shorted stocks lose money as prices unexpectedly rise. Recognizing bear traps can save you from major losses. Finally, beware the opposite, bull traps. Bull traps occur when prices appear ready to rise sharply, but instead collapse suddenly. Understanding bull traps ensures you don't get caught investing at the wrong moment. Next, let's understand alpha and beta, two critical measures investors use to assess performance and risk. Alpha measures how much an investment outperforms or underperforms compared to a benchmark. Positive alpha means the investment beats the market, indicating skillful management. Beta measures an investment's volatility relative to the overall market. A beta above 1 means the stock is more volatile than the market, while below 1 means it's less volatile. Next, let's decode spread, a key concept when buying or selling stocks. Spread refers to the difference between the bid price, what buyers offer, and the ask price, what sellers want. A smaller spread usually indicates high liquidity and active trading. Wider spreads mean higher trading costs, potentially affecting profits. Let's explore stop-loss orders, crucial for managing risk in investing. A stop-loss order automatically sells a stock if it drops to a specified price. Think of it as insurance, protecting you from excessive losses during sudden market downturns. Now, let's look at limit orders, an essential trading tool for investors. A limit order sets a specific price at which you're willing to buy or sell a stock. Unlike market orders, limit orders help control the price you pay or receive. Market orders are the simplest way investors execute trades immediately. A market order buys or sells at the best available price instantly. Quick and easy, but prices can vary significantly in volatile markets. Let's uncover margin trading, a powerful but risky investing strategy. Margin trading means borrowing money from a brokerage to buy more stocks than your cash allows. It magnifies profits, but also dramatically increases potential losses. Let's clarify hedge funds, which are often mentioned but rarely understood. Hedge funds are actively managed investment pools, often reserved for wealthy individuals or institutions. They use complex strategies to generate high returns, typically involving higher risks. Next, we have index funds, popular among long-term investors. Index funds track a market index like the S&P 500, offering instant diversification. They're famous for low fees and steady returns, perfect for passive investors. Let's look into asset allocation, a cornerstone of wise investing. Asset allocation means dividing investments among different assets like stocks, bonds, and cash. Proper allocation balances risk and reward, tailored to your investing goals and time frame. Now, what exactly is technical analysis? Let's dive in. Technical analysis studies past market data, charts, and patterns to predict future price movements. It's popular among short-term traders and market technicians. Let's contrast with fundamental analysis, another vital investing technique. Fundamental analysis examines company financials, earnings, and economic indicators to determine stock value. It's commonly used by long-term investors like Warren Buffett. Let's discuss yield, an important metric for income investors. Yield represents annual income, like dividends or interest, generated by an investment, expressed as a percentage. Higher yield often attracts income-focused investors. Now, let's explain commodities, another key investment area. Commodities are physical goods like gold, oil, or wheat that investors trade on global markets. They provide diversification and hedge against inflation risks. What about REITs? Let's uncover this unique investing tool. REITs are companies that own, operate, or finance income-producing real estate. They allow investors to earn income from real estate without owning physical property directly. Let's clarify portfolio diversification, critical for investment safety. Diversification means spreading your investments across various assets and sectors. It's the investing equivalent of not putting all your eggs in one basket. Arbitrage might sound complex, but let's simplify it. Arbitrage is profiting from temporary price differences of identical assets in different markets. Investors exploit these gaps for quick, risk-free profits. Let's expose the infamous pump and dump scheme. Pump and dump occurs when investors artificially inflate a stock's price and then sell quickly for profit. It's illegal and leaves unsuspecting investors with heavy losses. Let's define insider trading, an important term to recognize. Insider trading involves buying or selling stocks based on confidential, non-public information. It's illegal and can lead to severe penalties or jail time. Now let's look at sector rotation, a strategy investors use. Sector rotation involves shifting investments across different market sectors based on economic cycles. Investors use this strategy to maximize returns and manage risk. Finally, let's understand buybacks, a term frequently mentioned by companies. A buyback occurs when a company repurchases its own shares from the open market. This reduces outstanding shares, increasing stock prices and shareholder value. Let's now break down FOMO, a modern investing behavior you should be aware of. FOMO stands for fear of missing out, the anxiety of not participating in a hot investment trend. It often leads to emotional buying at market peaks and regrettable losses. Similar to FOMO is FUD, a powerful market sentiment driver. FUD stands for fear, uncertainty, and doubt, emotions that cause panic selling or hesitation. Recognizing FUD helps you avoid irrational decisions and stay calm under pressure. Let's explore candlestick patterns, a key tool in technical analysis. These patterns are visual representations of price movements over time. Common patterns like doji, hammer, and engulfing can indicate market reversals or trends. Another essential concept is moving averages. A moving average smooths out price data over a specific period to identify trends. The 50-day and 200-day moving averages are commonly used by traders and analysts. Let's explain resistance and support levels, fundamentals in chart reading. Support is the price level where a stock tends to stop falling. Resistance is the price level where it often struggles to go higher. These levels help traders predict entry and exit points. Now let's demystify the term derivatives. Derivatives are financial contracts whose value is based on underlying assets like stocks, bonds, or commodities. Examples include options, futures, and swaps, often used for hedging or speculation. Next up is leverage, a high-risk, high-reward strategy. Leverage means using borrowed money to increase the potential return of an investment. While it magnifies gains, it also amplifies losses dramatically. Let's understand float, a technical yet essential stock term. Float refers to the number of shares available for trading by the public. A lower float can mean higher volatility due to limited supply. Let's define earnings per share, or EPS. EPS measures a company's profitability, calculated as net income divided by outstanding shares. It's a key metric investors use to assess a company's financial health. And finally, let's break down return on investment, or ROI. ROI shows the percentage gain or loss from an investment relative to its cost. A higher ROI means better efficiency and profitability of your investment. Understanding these terms immediately transforms how you react to market news. Investors become calmer and less emotional. Terms become helpful guides rather than intimidating jargon. You confidently avoid panic selling or reckless buying. Clarity reduces stress, enhancing your investing performance. You'll avoid common mistakes beginners repeatedly make. Financial decisions become thoughtful, disciplined, and strategic. No more guessing. Knowledge guides your investment journey. Clear language equals clear decisions equals financial freedom. Empower yourself through knowledge. Your future depends on it. Mastering these terms creates smarter, more informed investors. Markets become transparent instead of intimidating. Investors make wiser decisions, leading to better long-term outcomes. The gap between professionals and everyday investors shrinks. Investing becomes accessible and fairer for everyone. This collective wisdom stabilizes markets. A clearer understanding means reduced market volatility and fear. Future generations benefit from informed investing habits. Financial literacy creates generational wealth. You're part of building a healthier investing future. But knowing terms alone won't guarantee success. You need strategies. How does Warren Buffett actually pick stocks? My next video reveals Buffett's exact strategy. It's simpler and more powerful than you think. Click here to learn Buffett's investing secrets. Subscribe now to master investing step by step. Empower yourself, build wealth, invest wisely. Your financial future begins here. Thanks for watching and investing your time wisely. See you in the Buffett video. Click now.